Good evening, everyone. Welcome. Thank you so much for joining us tonight for our student loan debt informational webinar. My name is Clarissa Gomez. I am a field representative for Assemblymember Jesse Gabriel, who proudly represents the San Fernando Valley. And tonight, our office is one of the main organizers for the event. So thank you again for joining us. I want to quickly just thank our event partner who will be leading today's presentation, the Campaign for California Borrowers' Rights. These folks have worked very hard to bring you a great presentation with valuable and updated information on student loan debt. Before I pass it over to them for the presentation, just want to thank a few folks for helping us get tonight organized. Big thank you to Assemblymember Celeste Rodriguez, Assemblymember Nick Schultz, Senator Caroline Menjivar, LAUSD board members Nick Melvoin, Kelly Gonis, and board president Scott Schmerelson. All these folks and their staff made today possible. So thank you so much for your partnership on this event. I'm going to go ahead and pass it over to the California Borrowers' Rights to go ahead and start today's presentation. Thank you again so much for joining.
Good evening, everyone. My name is McKenna Mustaza with Next Gen Policy. Before I kick us off, I just want to share some important information about this webinar. The webinar is being recorded, so your microphone, video, and chat have been disabled and will remain so for the duration of our time together. If you have a question, please submit it using Zoom's Q&A function, and all information presented in this webinar is accurate as of this date today. So to give a little bit of background on the Campaign for California's Borrower Rights, we are a leading statewide coalition of students, workers, consumers, older people, communities of color, veterans, and millions of others of Californians that are affected by the student debt crisis. We're working to ensure that student borrowers see a future free of debt. So these are the following organizations that represent the Campaign for California Borrowers' Rights. Protect Borrowers, Student Debt Crisis Center, Next Gen California, and Young Invincibles. To give you all an overview of today's program, we will be discussing what student debt looks like across California today, the federal updates that you as a borrower need to know, the different loan types and servicers, repayment plans, consolidation, and what debt relief currently looks like. Some important information is that the information that we share here today, it's accurate at the time of this presentation, and we're not financial counselors or attorneys. We are advocates and experts that are here to help you. What student loan debt looks like in California. So currently in California, there are 4 million borrowers that owe over 171.9 billion worth of student loan debt. So the average amount of debt that a California borrower owes is about 37,000. The majority of this debt is held by borrowers between the ages of 39 and 49 years old. And what we know is that there are over 750,000 older borrowers across the state, and that older borrowers are the fastest growing group of student loan borrowers. Currently, 14% of California's borrowers are in delinquency, which means that they are behind on their student loan payments. But in the United States, overall, borrowers currently owe $1.78 trillion of student loan debt. And with this, I'm going to go ahead and kick it off to Aisa.
Thank you so much, McKenna. Hello, everyone. My name is Aisa Canchola Banyas. I'm the Policy Director for Protect Borrowers. We are a national nonprofit advocacy, policy, research, and litigation organization. And we push for policies that alleviate the burden of debt for American families and create an economy that no longer places a massive price tag on opportunity. We are so proud to be a co-leading organization as part of the Campaign for California Borrower Rights. And so picking up where McKenna left off, the student loan debt crisis looks very different across each and every state. But we do know that the burden of student debt falls disproportionately on low-income borrowers, on women, and people of color. And this is due to many systemic policy decisions that have been made over the last few decades. So we've seen rising costs of tuition and fees at public colleges and universities that historically had been much more affordable, result in people having to take on larger amounts of debt. We've seen the racial wealth gap the racial wealth gap that has made it harder for families of color to accumulate wealth that they can then pay for their children to attend college. And as a result, because Black and Brown families have less familial wealth, they have to take on a higher amount of debt in order to finance their higher education. And we've also seen predatory institutions, for-profit colleges, really prey upon vulnerable communities in particular. And that these institutions have been found to leave their students with significantly higher debt loads, and unfortunately leave them with poor quality degrees that do not lead them to increase their earning potential and increase their economic mobility. In fact, a borrower in a, oh, sorry, go back, please. So just a couple of tidbits on the student debt crisis. Women hold nearly 2/3 of all the national student loan debt that is owed. Black women also are the highest indebted student loan borrowers across the country as well, and unfortunately have the highest rates of default. Next slide, please. And as McKenna had mentioned in her slide, this kind of the misinformation about who student loan borrowers are tend to focus on, millennials and younger people. But in fact, the student loan debt crisis and the challenges that student loans pose on families actually are disproportionately burden older Americans. So borrowers aged between the ages of 50 and 61 owe $283 billion in federal loan debt. And borrowers age 62 and older owe 117 billion. Older borrowers are the fastest growing segment of student loan borrowers across the country, and these are folks who are particularly economically vulnerable. These are folks on fixed incomes, folks who are having to delay retirement in order to stay on top of their student loans. Next slide. So one of the first things that we wanted to touch base or to touch on this evening, folks I'm sure have been trying to keep up with the headlines on what is happening in Washington as it pertains to the Department of Education, what student loan borrowers need to know. And the fact of the matter is there has been so much happening that it is nearly impossible for folks like us who work day in and day out in this space to keep track of it all. So we did want to just provide some high-level updates on what has been happening most recently at the Department of Education under the Trump administration. What do borrowers need to know, and what do parents need to know if they are having a student who is thinking through how to pay for college in the near future? So most recently, we have seen, this administration take a very hostile posture to the Department of Education. We have seen this Secretary of Education, as well as the President, take efforts to dismantle major aspects of the Department of Education. Since the administration took office, we've seen massive reductions in force. There is now over 50% of staff that have either been lost or been pushed out of their jobs. And how this, will go on to affect families and students is that there are less people in these positions to be able to respond to issues that students might be facing as they're trying to fill out the FAFSA to figure out how much federal aid they're going to get. There are less people who are going to be available to answer questions related to student loans, or if somebody is having trouble keeping up with their student loan payments. And we have really seen these results in real time, as there are massive backlogs and wait times for people who have submitted complaints and are just waiting for somebody to respond to them. On the topic of delays, we know that these kind of developments have also resulted in massive delays for student loan borrowers who have been submitting applications to access affordable monthly student loan payments. These are known as income-driven repayment plans, and these are guaranteed rights to federal student loan borrowers who might be struggling, and they allow a student loan borrower to tie their monthly student loan bill to their income. Well, unfortunately, there are over 1 million pending applications at the Department of Education from borrowers trying to access these more affordable payments, which is only adding more stress to, a lot of the kind of affordability issues that many folks are experiencing right now in today's economy. There are millions of borrowers who were enrolled in an income-driven repayment plan called the SAVE plan. And this plan has been challenged in court for now over a year. And this administration has been making policy decisions that will be making it harder for these borrowers in particular to remain on that plan. Most recently, deciding to begin resuming the charges of interest on these borrowers who've been in a kind of a forced payment pause of forbearance as a result of the lawsuits. And then we are approaching a massive default cliff. So when borrowers fall behind, they can go into default on their student loan, and could become subjected to a host of really, really harmful economic responses. So folks could have their Social Security benefits offset, they could have their tax refunds offset, and their wages directly taken from their paychecks. And this administration announced earlier this year that for the first time in 5 years, they are going to begin subjecting Americans with student loans who have fallen behind to those types of debt collection practices. And so all of this has really kind of exacerbated the confusion, the fear, and anxiety that we hear a ton from borrowers who reach out to us with help for their student loans. So wanted to set the stage. Next slide, please. To kind of talk through that, to acknowledge that kind of level set, and then kind of provide you all with some actionable advice and tools that you could use to navigate all of this uncertainty. But before that, we did want to talk about recent legislation that was passed out of Congress and signed by President Trump this past summer on July 4th, known as the One Big Beautiful Bill Act. It was passed through a reconciliation process, which means essentially it was a very fast track budget process that allowed congressional Republicans, the majority in Congress, to pass this bill with a mere kind of majority vote. What students and families who care about access to higher education need to know is that the bill did cut over $300 billion from financial aid programs that were meant to help improve college access and affordability. And the new law will unfortunately make paying for college and repaying student loans much more expensive. Next slide. So these are things that folks should know about the One Big Beautiful Bill. So after July 1, 2026, when the bulk of the new law's provisions go into effect, this new law will limit access to federal financial aid. It does this specifically by eliminating the Graduate Plus Loan Program. This was a loan program that was available to students who were pursuing graduate level education. And it also limits how much parents can borrow to help their children pay for college, known as Parent Plus loans. The law also reduces how much students can borrow across federal loan programs. And I will go into the next slide on exact kind of loan limits. But something that needs to be known is that if you are currently a student, current student loan borrowers are going to be essentially grandfathered into the current loan types. So if you are a current student, you will remain eligible for the Parent Plus loan, and you will remain eligible for the federal loans under the current loan limits for the next 3 years. If you are in a current program, you will not kind of immediately lose access to this funding stream, but this will go into effect for new students who take on new loans after July 1, 2026. And unfortunately, this will make it harder for folks to finance a college degree. Federal loans are available to students and borrowers and families regardless of their financial circumstances, regardless of their credit score. so because of that, it's been a way to protect people from having to go to the private market to access federal finance or to finance their higher education. And so with these funding streams off the table, it's going to result in people having to take on more private loans from private banks. Next slide. So I will not go through every single line, but this is a recorded presentation that we plan to share with folks after. But this is kind of an overview of how the prior limits were set before the law was passed, and then provides an overview of like what the new law does and how it lowers the current borrowing limits. I think the things that are most important to note is that if you are somebody who is pursuing medical education, and that's kind of anybody who wants to take on an MD or pursue dentistry or veterinarian programs, the loan limits now that are in effect after this law have been set significantly lower than the average cost of a graduate of a professional degree in this space. And so these are going to be some of the fields that are going to be most affected by having students, really kind of struggle to figure out how they're going to pay for these very expensive programs. Next slide. So that was on the front end in terms of what the new law does in order with regards to access to federal financial aid. On the back end, the new law limits repayment options for borrowers. So after July 1, 2026, again, that special date in which the bulk of this law goes into effect, there will be one new standard repayment plan. This is going to be one new standard repayment plan and one new repayment assistance plan, also known as the RAP plan. Both plans will be more expensive for borrowers. The standard plan will offer a fixed payment term based on how much loan debt a borrower has, whereas the RAP plan will be the one and only plan that a borrower has to set their monthly bill to their income. It will be it'll be determined on a borrower's adjusted gross income and requires all borrowers to make a minimum payment of $10 a month, and extends the repayment requirement timeline from 20 to 25 years, which is all of the current repayment plans, repayment terms, to 30 years. And then something to be noted is that if you are a current student loan borrower who is enrolled in an income-driven repayment plan or is considering enrolling in an income-driven repayment plan, if you are a current borrower, you can remain on your repayment plan until no later than July 1 of 2028. After that, though all current borrowers will be moved into either the new RAP plan or a new version of the income-based repayment plan. I know this is a lot of information. We'll go into all of the different parameters of all the plans in a second, but these are just things that folks kind of need to keep in mind as we're getting closer to seeing a lot of these provisions going into effect. Next slide, please. So here is an overview of the new standard plan versus the new repayment assistance plan. Folks will see on the left, we have the standard plan that provides fixed terms based on how much a borrower takes on in loan debt while they're going to school. And then the repayment assistance plan is pegged to how much income you make. And then it goes all the way up to 10% of adjusted gross income for somebody who makes above $100,000 plus. Next slide, please. In addition to these big kind of provisions or changes to access on the front end and access to affordable repayment options on the back end, the new law will make it harder for defrauded students to access relief. We talked about the predatory for-profit college industry that has kind of grown rampant more recently. The new law does weaken regulatory rules known as the borrower defense rules that hold these schools accountable for saddled with massive amounts of debt. And so this will essentially make the process harder to navigate for borrowers who have been defrauded by their school. And then we also expect that due to the unprecedented cuts in the One Big Beautiful Bill to programs like Medicaid and SNAP, we do expect, state budgets to really feel the strain. And as a result, states could be more likely to have to cut their state higher education programs, which could lead to higher tuition rates. So things to kind of keep in mind as we move closer to this July 1 date of next year. Next slide, please. So things to be aware of even between now and that July 1 date. So changes to income-based repayment. The new law allows more current borrowers to qualify for income-based repayment. If you are a student loan borrower right now and you are not planning on taking on any additional loan debt, and you are not currently enrolled in an IDR plan, you may consider going onto your FSA.gov website and thinking through enrolling in an IBR plan. This will allow you to tie your monthly bill to your income and allow you to get on a path to get debt relief after 20 or 25 years. It's important to look into that because if you are potentially eligible for these more affordable payment plans, if you wait until after the July 1 date and the July 2028 date, you could be essentially losing access to IBR and will only have access to the RAP plan. And then for borrowers who are parents and who took on a Parent Plus loan, this is something we've been trying to kind of share this PSA out for as many people as possible. New Parent Plus borrowers will lose access to any kind of income-driven repayment option after July 1 of 2026. And so if you are a current Parent Plus loan borrower and are not currently enrolled in an IDR plan, you should consider whether consolidating your loan is an option that could work for you. Because at this point, if you are to consolidate your loan prior to July 1, 2026, you will be able to access an IBR plan and have access to a payment plan that will let you to tie your bill to your income. But if you wait until after July 1, 2026, you will only have access to the standard repayment plan. And so that is something that folks in this particular scenario should consider. Next slide, please. And with that, I will turn it over to my fabulous colleague, Katrina.
Thanks, Aisa. Hi, everybody. I'm Katrina, the Western Director over at Young Invincibles. So Aisa outlined a lot of the changes to loans and repayment options that we'll see in the next few years, but I'll just go through a few of the loan types you may encounter and how each of these are serviced at the current moment. So the big picture is there are two main types of student loans, your federal loans and your private loans. Federal loans being from the government and private loans from banks or other lenders. Federal loans generally offer lower fixed interest rates and a variety of repayment plans, including options that adjust to your income, making them generally safer and more flexible than private loans for most borrowers. On the federal loan side, the most common ones are going to be your direct subsidized loans, best options for undergraduate students, and the government pays that interest while you are in school. Direct unsubsidized loans are available to both undergraduate and graduate students, and the interest starts right away on those. While Graduate Plus loans are for, of course, graduate students, but starting again in July 1, 2026, these will no longer be available to students. Parent Plus loans are, of course, for parents to borrow to help pay their children's educations, and consolidation loans let you combine multiple federal loans into one simple payment. Some other programs that are a bit older, Perkins loans and FFEL loans, are no longer given out, but some people are still repaying them. And then private loans, again, come from banks or credit unions, usually cost more and don't have the same protections as our federal loans. Again, important highlight, starting July 1, 2026, graduate students will not be able to take out those Graduate Plus loans, and they'll need to look ahead for other funding sources in pursuing your education. When you take out a federal loan, the money comes from the U.S. Department of Education, but they don't handle your monthly payments. Instead, they assign you a loan servicer, and that company then manages your account, sends you your bills, and helps you with your repayment options. For direct loans, on the other hand, which are the most common type, the main servicers are companies like Ed Financial, Central Research Office, Nelnet, and Mohila, amongst others. And if you have one of these, they're the ones you'll see on your billing statements. If you have older loans, your servicer might be companies like Heartland or Sallie Mae. These aren't offered anymore, but many borrowers are, again, still paying those back. Important note for y'all, your servicer is your main point of contact for questions about repayment, deferment, or forgiveness. So pay attention to which company you're assigned to and set up your online account there. On the private loan side, oh, sorry, go ahead. Right there, perfect. Common lenders on the private end, of course, are going to be Discover, Navient, Sallie Mae, Wells Fargo, SoFi, all those big banks I'm sure you've heard of before. And if you take out a private loan, your lender will then manage your account, send you your bills, and handle your repayment. Next slide, we'll quickly go through how to use a studentaid.gov website. This is where you'll manage your student loans, navigate your payment options, among other things. If you have questions about your loans or programs, utilize this website. You'll want to log in to fsa.gov or your student loan servicer for information on your student loans. And that website there, studentaid.gov. I'm sorry, can't read today. On your FSA dashboard, you'll see all of your grants and loans, including who your servicer is. And then you'll see also a breakdown of the types of loans you currently owe on that next slide. So here's just like a quick run through on how you'll log into your account, a phone number that will help you navigate logging into your account. If you're not able to access it, you'll use your FSA ID username, your email, or your phone number to access that. And then again, on this page is your dashboard where you'll be able to see your loan servicer, all those details with that view detail button that'll take you to your types of loans for repayment. And once you click view details, you should see this screen pop up where it will show you all the different types of loans you owe, your current balance, and your interest being accrued. And if you keep scrolling down, you'll be able to see that breakdown of your loan types that we just quickly covered right there. Okay, so now we'll go through a few loan repayment options. Beyond federal programs, California does offer its own loan repayment and forgiveness options, especially for people working in healthcare, mental health, and public service. These programs can make a huge difference, tens or hundreds of thousands of dollars in repayment assistance. For example, one you'll see here is the Stephen M. Thompson Physician Corps program, offers up to $105,000 for physicians serving in underserved areas. The Cal Healthcare's program can provide up to $300,000 for doctors and dentists. There are also targeted programs for nurses, mental health providers, and allied health professionals, each with different service requirements. And the best place to find up-to-date information on this and apply to these loan forgiveness programs is going to be through the California Department of Healthcare Access and Information. That website is linked right there at the bottom. We'll be sure to share these slides with you and all the important links. And even if you don't qualify for these big ones that we've outlined here, it's worth exploring. There are programs as small as $6,000 and as large as $300,000. And with some of the things that we heard today about PSLF, California is considering how we support people in public service here in the state as the federal landscape remains uncertain. So hopefully something in California will support loan borrowers in the coming years. On this next slide, the 10-year standard repayment. When you first start your repayment, your loans are automatically placed in the 10-year standard repayment plan. That means your monthly payment is fixed and designed to help you pay it off in 10 years. It's straightforward, but for those just starting out, it can be pretty high. If that's the case, there are other options that we'll go through shortly, like income-driven plans, extended plans, and that can make it more manageable. The key is to know that you're not locked into this plan forever, and you can switch if it's not affordable for your needs. So, as we go through some of the payment options, repayment isn't a one size fit all. There are several different plans, and the best one for you really depends on your income goals and eligibility. If you're not sure, again, which plan you're in, head to studentaid.gov or call your loan servicer and they can help you with that. So as we come through this next one, on income-driven repayment plans, they are designed to make student loan payments more affordable, especially for those with lower or more unstable incomes. Instead of basing your payment on how much you owe, IDR plans calculate your monthly payments as a percentage of your discretionary income. That's your income after essential expenses adjusted for your family size. This will help people who have maybe lost their job, have a lower income, or are in between jobs, and helps you stay current and avoid delinquency or default. Another benefit here is that your lower monthly payment is locked in for a year, giving you some stability while you figure out the financial situation. The trade-off is that you would likely be paying a longer repayment period, anywhere from 20 to 25 years. But for many, this offers a really great peace of mind on affordability and is a great option for folks. So on the next slide, a lot of questions we get are what's the difference between an IDR and an IBR? It's a super common question. The income-driven repayment is an overall category for different types of repayment plans. Under that umbrella, there are several specific plans. You might have seen these acronyms: IBR, ICR, pay, save, and they all have different formulas and eligibility rules. So if somebody says they're on an IBR plan, they're likely they're in an IDR plan, just one particular type of it. And we can share more resources on the differences between all of these different types of loans shortly. So here's a quick comparison of those different repayment plans. They mostly differ in how much income they take into account and how long you'll make payments. The newer IBR and pay plans have a cap of 10% of your income and forgive the remaining balance after 20 years. Older plans like the traditional IBR, ICR might take 15 to 20% and stretch to 25 years. And then the Parent Plus borrowers should know there's also some changes happening here. IBR is being extended, but it's rolling out slowly, so double check with your loan servicer. And then what happens if you don't make payments? I did see a few questions in the chat around delinquency challenges or issues like that. This is where things can really snowball. First, you'll go into delinquency. That starts as soon as you miss a payment. It will continue until you catch up or get into deferment or forbearance. After 90 days, your loan servicer will report your delinquency to a credit bureau, which can hurt your credit scores. And then after 270 days, about 9 months, your loan goes into default. And that's when the federal government can take collection actions like withholding your tax refunds or garnishing your wages. The good news is, though, you can get out of a default through loan rehabilitation or consolidation, and both lead to getting back in good standing and on an affordable plan. So again, that temporary on-ramp protection ended in September 2024. So missed payments really do count. If you're struggling, contact your servicer, especially important to do so before you fall behind. So how do you identify your monthly payment on different plans? There's two different ways you can do so, one through that loan simulator and one by calling your servicer. The loan simulator is convenient to access. It'll give you that quick snapshot that we just showed you, and we'll show you what your payment might look like under different plans. If you need more precise information, like the Public Service Loan Forgiveness Program, you'll want to call your servicer directly. And when you do ask, what repayment plans am I eligible for and what should my monthly payments be under each? And make sure that you mention that PSLF if it applies to you. The one thing to note here is that they do have long hold times, but it is worth it to call if you want that extra peace of mind to understand if you're in the right plan or not. And just touching on Parent Plus loans real quick, as well as those income contingent repayment plans. Parent Plus loans work a little differently when it comes to income-driven repayment. Right now, it is available to Parent Plus loans. Or sorry, the main IDR option available is going to be the ICR, but it is being phased out. To qualify, you do need to consolidate your loans into a direct consolidation loan by July 1, 2026. So just 6 or 7 months away from now. And once consolidated, you can enroll in the ICR. But you'll only be able to stay in that plan until July 2028 when ICR is set to sunset. To remain in an IC income-driven plan after 2028, borrowers will need to move into one of the newer options before then. And if the ICR doesn't work, there will still be other repayment options that you can look into, such as that extended, graduated, or extended graduated plans. I know these are a lot of big acronyms and programs that we're outlining, so thank you for staying with us on these. Also on the Parent Plus loans, we have income-based repayment options. They are being opened up to Parent Plus borrowers soon, once again, later this winter. To qualify, you do need to first enroll in that ICR plan and make at least one payment under that plan. Once you've made it to that plan, you should be eligible to switch to an IBR, which will generally mean lower monthly payments compared to that ICR. Again, just noting, you will want to enroll in this by July 1, 2028 to stay in it following 2028. And thank you. So you heard me mention federal loan consolidation. What is it exactly? Basically combining all of your federal loans into one direct loan, direct consolidation loan, giving you one loan, one payment. You might have done this with credit cards, consolidating them into one loan, or similar actions to support with debt relief. When you consolidate, you're essentially creating one new loan, new payoff timeline, new payment amount. The process typically takes 30 to 60 days, and you can consolidate again into one, such as a single parent plus loan, if you need to access an IDR or PSLF benefit. If you have an older loan, you can convert those into direct loans to qualify for programs like PSLF as well. A big caution here, if you consolidate right now, it can reset your payment history, your repayment history, and PSLF progress to 0 because it counts as a brand new loan. So you'll want to consider your PSLF status when making that decision before moving forward with that. Understand the trade-offs, but it can be beneficial, but your timing and purpose for doing so really does matter. Here are some new loan consolidation changes. The major upcoming changes you should be aware of. If you are a Parent Plus borrower and you want to enroll in ICR, you'll need to consolidate into a direct loan and get in before July 1, 2026. After that date, things will be changing drastically. Anybody who consolidates after that date will only have those 2 repayment plans that Aisa mentioned earlier, that standard plan or the new WRAP plan. That means no access to our income-driven repayment options after that point. So get started before that July 1, 2026 deadline. And closing us out here, how can I apply for consolidation? If you do want to apply for loan consolidation, you can do so online at that studentaid.gov website. You see a longer URL there that you can type in, take a photo of, and type that into your computer, or you can use a paper application if you prefer that. If you're consolidating in order to enroll in an IDR plan, make sure you submit both applications together, the consolidation and the IDR enrollment. And then keep in mind, consolidating can reset your repayment and PSLF credit since you're creating a new loan. It can take 30 to 90 days. And yeah, once again, if you're considering it, give yourself a cushion. We have 6 to 7 months to get to that new deadline. And please feel free to drop any chat questions into our Q&A box. And I will pass it over, I believe, to Angel.
Hello, everyone, and thank you, Katrina. So let's dive into the SAVE plan. The SAVE plan is a Biden-era income-driven repayment plan, an IDR plan, and it stands for Saving on a Valuable Education. Right now, there are lawsuits surrounding the SAVE plan. So 18 state attorney generals, led by the state of Missouri and Kansas, blocked the SAVE plan. No one can enroll in the SAVE plan as of this moment due to the ongoing litigation. And all people who are enrolled in the SAVE plan have been placed into a forbearance, which means they do not have to make a monthly payment. However, one thing to note, and Aisa mentioned this earlier, interest is accruing on the SAVE forbearance for folks who are enrolled. So we are going to go ahead and answer in the next slide a very pressing question, and we've seen this already in the chat. Can we go to the next slide, please? Thank you. Should I stay enslaved or should I not? And to keep it very simple, there is no right or wrong answer. It varies by case. Some things to consider is if you would benefit from not having to make that monthly payment and you don't mind not earning public service loan forgiveness or income-driven repayment plan credits, or you are willing to take the risk of taking the buyback option when you're close to loan forgiveness, then you may consider staying in the SAVE plan. On the other side of the coin, if you are thinking of switching out of the SAVE plan, this might be if you are really, really close to public service loan forgiveness or have just enough income-driven repayment plan credits to meet that threshold to get your loans forgiven. One thing to keep in mind, not all borrowers are eligible for all income-driven repayment plans. And since things are changing very rapidly, it's very important to stay up to date with the information provided through our partners or on studentaid.gov. Now, if you do decide to switch out of SAVE, or if you need a more affordable monthly payment, how do you apply to an income-driven repayment plan? Our best recommendation is to apply online. You can do so by clicking on the link here on the slide, and which we'll share. If you do decide to go ahead and apply through paper form, it might take a bit longer. We have been seeing that online applications process faster, especially if you click on IRS integration. Just keeping in mind that processing times are extremely delayed, especially by paper form, but we have seen them getting processed way quicker if you apply online and click on IRS integration. Now, what do you need to know before applying for an IDR plan? First things, you need to know your mailing address and permanent address, your family size, employment information and employer address, income documentation. It's gonna be your W-2, your pay stub, a letter from your employer certifying your gross income, a bank statement, or interest or dividend statement. And like I mentioned before, if you enroll in IRS integration, it should process faster, but sometimes you are still required to provide income documentation. So it's something to go ahead and keep in mind. One thing to keep in mind as well is that when you are filing taxes for when it comes to income-driven repayment plans, if you're married filing jointly, both incomes get taken into consideration. So one thing to keep it also to highlight, if you were married filing jointly and you're now separated or divorced, or you don't have reasonable access to your spouse's current income, they won't factor in that income or loan debt when calculating your IDR payment. Now, if you're married filing separately, your spousal income is not considered. And this is very, very important. Starting next year, tax-free student loan forgiveness on the federal level is ending unless it is extended by Congress. Beginning in 2026, any federal student loan forgiveness that gets forgiven past that date of December 31st, 2025, will be taxed as income, and which will have to be paid in addition to the taxes that you're filing for. Another thing is that if you meet the requirement for income-driven repayment forgiveness by that December 31st, 2025 date, you should not have to pay taxes for your student loan forgiveness, even if it gets processed in 2026. That was an outcome of one of the current lawsuits that's going on with AFT and the Department of Education. So even if the student loan forgiveness gets processed next year, it will not get taxed as long as you meet the requirements by December 31st, 2025. And also, IRS integration has resumed on income-driven repayment plans applications. There's no need to document your income anymore if you opt into integration, but we still recommend you do since there might be system errors. So once a year or every 11 months, go ahead and recertify your income. Some other changes for IDR plans. Anyone looking to enroll in pay as you earn or income contingent repayment will need to do so before July 1st of next year. This will be because borrowers will lose the ability to enter these plans after the date of July 1st, 2026. No one can apply for SAVE at this time, like I mentioned before, but you can apply into another plan to leave Save. But once you leave Save, you cannot come back into Save. So that's something to keep in mind if you are planning on leaving Save. Another plan that was touched on earlier in the presentation is the repayment assistance plan. That one is rolling out on July 1st of 2026. No one can enroll in it right now, but it will be available in the near future. Now, also for folks enrolled in Pay, Save, and ICR, you could remain in these plans until July 1st of 2028 is when it's slated to be rolled out. At the latest, it could be sooner, so really know your options before that date. And if existing borrowers don't choose another plan by that time, and if they're enrolled in with those, the direct loans will be placed on the RAP plan, and any loans that don't qualify for RAP will be placed in income-based repayment. And that's specifically for Parent Plus loans, as an example. Now, some pathways to debt relief. So we're going to touch a bit of a public service loan forgiveness. Public service loan forgiveness is a program that started in 2007. It's essentially after you make 120 monthly payments, which is equivalent of 10 years, your remaining loan balance gets forgiven. One thing to keep in mind is that the payments are not cumulative, I'm sorry, are cumulative and not consecutive, and all remaining forgiven debt is tax-free. So that's different than the income-driven repayment forgiveness. Something to keep in mind. Do you have a direct loan? You need to have a direct loan to be eligible for PSLF. Does your employer qualify? We'll go over that in a bit. Are you in a qualifying repayment plan, which we'll also touch on? And we'll also touch on documenting your employment using the PSLF form and applying once you reach 120 payments. So the whole point of PSLF and to get the most maximum benefit is if you enroll in an income-driven repayment plan, you have a low monthly payment, and then you apply for PSLF, Public Service Loan Forgiveness, you get the maximum benefit since you essentially pay the least amount back in your federal loans. So the whole point is just you pay as little as possible and benefit from both a low payment from income-driven repayment and the Public Service Loan Forgiveness. Now, who qualifies for public service loan forgiveness? In terms of loans, direct subsidized and unsubsidized loans qualify, direct graduate plus loans qualify, and also direct consolidation loans, including one created with the Parent Plus loan. For employers, all levels of government, tribal, federal, state, local, all of those qualify. 501(c)(3) nonprofits and other critical public service careers. The repayment plans include standard and income-driven repayment. What does not qualify? Loans that are FFEL loans, Federal Family Education loans, Perkins loans. If you are defaulted on your loans, you do not qualify for PSLF and private student loans. For employers, government contractors, so if you're not a government employee and you work for the government as a contractor, you do not qualify. Labor unions, so if you're a member of a labor union, you do not qualify. And 501(c)(4) nonprofits and political groups. And repayment plans, the fixed alternative repayment plans, and repayment plans that are for deferment, forbearance, and default. And I'll go ahead and pass it on to Aisa to touch on the last section of our presentation.
Hi, everyone. So we have been throwing so much content at y'all, and I want to make sure we save time for questions. But we did want to make sure to flag for everybody that all of the information that we've been sharing can be accessed on the federalstudentaid.gov website. That is the place that you should be looking for any and all information regarding your specific loan information. To get information on who your loan servicer is, and how to access information on your payment history, your pathway to potentially getting student loan forgiveness. And so because of all of this uncertainty and so many developments happening at the federal level, there has been a growth of scams, of organizations essentially trying to take advantage of the anxiety and fear that borrowers are having right now. So we are reminding everybody that there is nothing a company can do for you that you can't do on your own for free through the Federal Student Aid website or through your servicer. Loan servicers in the federal government do not call you on your phone, and do not ask for your social security number. So sharing that kind of personal information is never a good idea. And if someone is offering some sort of special access to guidance and services, that is a very likely sign that this is a scam. And if you are experiencing this, you should file a complaint with the Department for Financial Protection through California, known as DFPI, or the Federal Trade Commission. Next slide. And so there are places where you can go to submit a complaint if you have been subjected to a scam, if you are having trouble navigating your student loans. And so I had mentioned so through the Department of Education, they have a loan ombudsman's office. Here you could resolve discrepancies with your loan balances, with your loan payments, identify any potential options that you might have with dealing with your student loans. And to access this assistance, you can go to ombudsman@ed.gov. Just know that there may be a delayed time with the government shutdown. Next slide. Another tool that we at Protect Borrowers created in light of all of the efforts happening right now to really diminish the capacity of the federal government is the Protect Borrowers Constituent Casework tool. Many folks don't know that congressional offices have entire teams of caseworkers charged with helping their constituents with issues dealing with their student loans or with their federal government. And if you have a federal student loan and are having an issue with the Department of Education or having an issue contacting your student loan servicer, you can submit a complaint request to your member of Congress. And we have actually heard through our partners with Legal Aid and other types of legal assistance organizations that this tool has been one of the few ways that people have been able to get some sort of resolution from their issues with their student loans. So this tool in particular walks you through the process of submitting a constituent casework form, and every single member of Congress, regardless of party, has this available on their website. So make sure to check that out and head over to our Protect Borrowers / Congressional Casework tool to access the tool as well. Next slide. And here we have compiled a slew of resources for folks to take a look at, starting with studentaid.gov, information on public service loan forgiveness, IDR, how to consolidate your student loans, and the casework tool, as well as how to access the student loan ombudsman within the Department of Education. Next slide. And then we have some additional important links here as well, which I know will be circulated to y'all after this presentation concludes. Next slide. And we did want to put a plug in for the Student Loan Empowerment Network. This is a network that is funded through California state funds, specifically to increase capacity for community-based organizations that can help student loan borrowers get help with their student loans. And so for more information on how to access this help, head over to studentloanhelp.dfpi.ca.gov. Next slide. All right. So we have gotten in so many great questions, and I want to make sure that we can do as many as we possibly can through rapid fire. So starting off with the first one, and Angel and other folks, Katrina, please feel free to respond as well if you if I miss anything. But the first is questions related to the SAFE plan. So are we encouraging folks to move to other payment plans? Angel had mentioned this. If you are a borrower who is hoping to access cancellation either through public service loan forgiveness or IDR cancellation, which is available after 20 or 25 years, you might consider moving off of the SAFE plan because the forbearance now is starting to accrue interest. And all of the months that you are spending in forbearance is not counting towards that cancellation time period. So folks might want to consider that. However, we do know that there are folks who just cannot afford to make payments right now. And so those are kind of the scenarios to consider. On the next question we got was about whether or not the new law makes any changes to student loan borrowers who are hoping to access public service loan forgiveness. Thankfully, there were no major changes to the public service loan forgiveness program under the One Big Beautiful Bill. And, aside from the fact that, folks are going to have to pay on more expensive plans in order to access public service loan forgiveness, because in order to access public service loan forgiveness, you have to be enrolled in an IDR plan. And for folks who are going to need to get on the RAP plan, their payments will be higher. The third question was about the PSLF buyback. And so there is information on the Department of Education's website on how to access the buyback. The buyback is a program that essentially allows borrowers to buy back months of time that might not qualify for public service loan forgiveness. The kind of important thing to remember with regards to the buyback is that you are only eligible to buy back PSLF eligible months once you've reached 120 months in your public service loan employment. And so if you are far off from PSLF, the buyback is probably not a good option. But if you are starting to kind of get closer to that 120 months, you might want to consider looking into the PSLF buyback option, and I'm going to include some information on that in the chat here. The other question we did get was, how will the shutdown affect current FAFSA applicants? And so from our understanding, folks who are trying to access the FAFSA, that there has not been significant disruption to the FAFSA process. However, we have heard that folks are experiencing delays hearing back from this ombudsman team because many of those folks have been required to be furloughed. And so if you are having issues with the FAFSA, it is possible that it might take you a little bit longer to hear back from folks at the department. So those are some of the questions that we have received thus far. Folks, are we getting any more questions? Do we want to do one more? Okay. The last question. Okay. So I'm going to try to do the last two questions in the last 2 minutes. So we received one on somebody who is in the forbearance limbo. I'm so sorry that this is happening, but works in a field that might be eligible for forgiveness. Should I pay interest? So there are some folks who are making the trade-off to stay in the safe forbearance and just pay the interest that is accumulating because the payment on another alternative income-driven repayment plan is just too much. It's just too expensive. And so if you are in a position where you are really needing this either $0 payment or just, wanting to make a dent in the interest, that might be an option. But again, you are choosing that option at the expense of making progress towards that cancellation. And again, everybody's situation is different, and we acknowledge that things are so expensive right now. And so folks are kind of having to make those trade-offs in real time right now. But that is an option we have heard borrowers take. And then I think the last question we will take for tonight is a question about where borrowers can see their payment history, and that they are feeling very nervous about the fact that their loan balance only seems to be going up. So folks should head to their student loan servicer's website. So folks will remember at the beginning of the presentation, we walked through studentaid.gov. If you do not know who your servicer is, head to studentaid.gov, log into your dashboard. It will show you who your student loan servicer is at the top right. And it will also include a link to your student loan servicer's website. Head over to your student loan servicer's website. That is where you can get all of your payment history information. These are third-party servicers. They contract with the federal government and are charged with helping borrowers manage their student loans. And that is where you can find all of that information. And with regards to loan balances going up, that is very common, especially if you are a borrower who is on an income-driven repayment. That gives you the benefit of having a lower monthly payment. But because of interest accumulating for several years, folks' balances do continue to accrue. That is why that 20 to 25-year cancellation window is so important, because it alleviates that. It's kind of that release valve for all of that accumulating interest that accumulates over the years. So with that, I am happy to turn it back to Clarissa with Assemblymember Gabriel's office.
Thank you so much. Really appreciate it. Thank you, folks, for a great presentation, an informative one. And thank you so much to all of those who attended. Really, really appreciate you folks joining us tonight. Hope everyone has a lovely evening, and thank you so much for joining us.